Welcome! In this video, we'll explore how to estimate the return on investment, or ROI, for knowledge-based software. ROI is a critical metric for businesses considering new technology, as it helps determine whether the investment will pay off in the long run. By understanding ROI, you can make informed decisions about implementing knowledge-based solutions. We'll break down the process step by step, starting with the basics and moving into practical calculations and real-world examples. Whether you're a manager, IT professional, or business owner, this guide will help you evaluate the true value of knowledge-based software for your organization. Before diving into calculations, let's clarify what ROI actually means. ROI, or return on investment, is a financial metric used to evaluate the efficiency or profitability of an investment. It's typically expressed as a percentage and helps you compare the gains from an investment to its cost. For knowledge-based software, ROI measures how much value the software brings compared to what you spend on it. Understanding this concept is essential for making smart business decisions and justifying technology investments to stakeholders. ROI is more than just a number, it's a decision-making tool. When considering knowledge-based software, ROI helps you weigh the potential benefits against the costs. This is especially important when budgets are tight or when you need to convince leadership to approve a purchase. By estimating ROI, you can demonstrate the tangible value of a knowledge base, such as improved productivity, reduced support costs, and better customer satisfaction. This makes it easier to prioritize investments that truly drive business growth. To estimate ROI for knowledge-based software, you need to identify its main components, costs and benefits. Costs include everything you spend to acquire, implement, and maintain the software. Benefits are the measurable gains, such as time saved, reduced errors, and improved customer service. By clearly defining these components, you set the foundation for an accurate ROI calculation. In the next scenes, we'll break down each component in detail and show you how to gather the necessary data. Let's start with costs. When evaluating knowledge-based software, consider both direct and indirect costs. Direct costs include software licensing fees, setup charges, and training expenses. Indirect costs might involve time spent by employees during the transition, ongoing support, and potential downtime. It's important to capture all these expenses to avoid underestimating the true investment required. Documenting costs thoroughly ensures your ROI estimate is realistic and reliable. Direct costs are the easiest to identify. These include the price of the knowledge-based software itself, any one-time setup or installation fees, and the cost of initial training for your team. Some vendors may also charge for premium features or integrations. Make sure to include all these items in your cost calculations. Keeping a detailed record of direct costs will help you compare different software options and choose the best fit for your budget. Indirect costs can be trickier to estimate, but are just as important. These might include the time employees spend learning the new system, temporary drops in productivity during the transition, and ongoing support or maintenance fees. Sometimes, there are hidden costs, like the need for additional IT resources or unexpected troubleshooting. By accounting for both direct and indirect costs, you get a more complete picture of your total investment. Now, let's shift our focus to benefits. The main value of knowledge-based software comes from increased efficiency, faster problem-solving, and better customer support. Employees can find answers quickly, reducing time spent searching for information. Customers get faster responses, leading to higher satisfaction. These benefits can be measured in terms of time saved, cost reductions, and improvements in service quality. Quantifying these gains is key to a solid ROI estimate. One of the most significant benefits is time savings. With a well-organized knowledge base, employees spend less time searching for answers or asking colleagues for help. This efficiency adds up, especially in larger organizations. To estimate time savings, track how long it currently takes to find information and compare it to the expected time with the new software. Multiply the time saved by the number of employees and their hourly rates to calculate the financial impact. Knowledge-based software can also lower support costs. When customers or employees can find answers themselves, there are fewer support tickets and less demand on your help desk team. This means you may need fewer support staff or can reassign them to higher value tasks. To estimate these savings, look at your current support volume and project how much it could decrease after implementing the software. A robust knowledge base leads to faster, more accurate answers for customers. This boosts satisfaction and can increase loyalty and retention. Happy customers are more likely to recommend your business and continue using your services. To measure this benefit, track customer satisfaction scores before and after implementing the knowledge base. Improvements in these scores can be linked to increased revenue and reduced churn. Knowledge-based software helps standardize information, reducing the risk of errors and inconsistencies. When everyone has access to the same, up-to-date information, mistakes are less likely. This can lead to fewer costly errors and less time spent correcting them. To estimate this benefit, consider the cost of errors in your current process and how much you expect them to decrease with the new software. As your business grows, a knowledge base can scale with you. Adding new content or users is usually straightforward, and the software can support more complex operations without a proportional increase in support costs. This scalability means your investment continues to pay off as your organization expands. Factor in future growth when estimating long-term ROI. To estimate ROI accurately, you need reliable data. Start by collecting information on your current processes, how much time employees spend searching for information, current support ticket volumes, and customer satisfaction scores. Also, gather cost data for software options you're considering. The more precise your data, the more accurate your ROI estimate will be. Before you crunch the numbers, set clear goals for your knowledge base investment. Are you aiming to reduce support costs, improve customer satisfaction, or boost employee productivity? Defining your objectives helps you focus on the most relevant data and ensures your ROI calculation aligns with your business priorities. The basic formula for ROI is simple. Subtract the total costs from the total benefits, then divide by the total costs. Multiply by 100 to get a percentage. In other words, ROI equals benefits costs divided by costs x 100%. This formula gives you a clear, comparable metric to evaluate the value of your knowledge base software investment. Let's walk through an example. Suppose your team spends 500 hours per month searching for information. With a knowledge base, you estimate this will drop to 200 hours. If the average hourly wage is $30, the monthly time savings is 300 hours. X $30 equals $9,000. This is just one part of your total benefits. Add similar calculations for reduced support costs and improved customer satisfaction to get your full benefit figure. Now, let's estimate costs. Suppose the software license is $5,000 per year, setup costs are $2,000, and training costs are $1,000. Add ongoing support at $500 per month. Your total first-year cost is $5,000 plus $2,000 plus $1,000 plus $500 x 12 equals $15,000. Be sure to include all relevant expenses for a complete picture. With your benefits and costs calculated, plug the numbers into the ROI formula. For example, if your total annual benefits are $30,000 and your total costs are $15,000, your ROI is $30, $15 divisé par $15, x cent percent égale cent percent. This means you're doubling your investment in the first year alone. A positive ROI means your investment is paying off. The higher the percentage, the greater the return. However, ROI isn't the only factor to consider. Think about how quickly you'll see these returns, whether the benefits are sustainable, and if there are any risks involved. Use ROI as one part of your overall decision-making process. Another useful metric is the payback period, the time it takes to recover your initial investment. Divide your total costs by the annual benefits to find out how many years it will take to break even. A shorter payback period means you'll start seeing returns sooner, which can be especially important for fast-moving businesses. For a more advanced analysis, consider net present value, or NPV. NPV accounts for the time value of money by discounting future benefits and costs to their present value. This helps you compare investments with different timelines and ensures you're making the most financially sound decision. To calculate NPV, estimate the cash flows for each year, then discount them using a chosen rate. Subtract the initial investment from the sum of discounted cash flows. A positive NPV means the investment adds value. While this calculation is more complex, many online calculators can help you get accurate results. Total cost of ownership, or TCO, is another important metric. TCO includes all costs associated with the software over its entire lifecycle, not just the initial purchase. This helps you avoid surprises and ensures your ROI estimate is comprehensive. Not all benefits are easy to quantify. Intangible benefits like improved knowledge sharing, better collaboration, and enhanced company culture can be significant. While these may not show up directly in your ROI calculation, they still contribute to the overall value of knowledge-based software. Every investment carries some risk. Consider potential challenges such as user adoption issues, integration difficulties, or unexpected costs. Assessing these risks helps you prepare mitigation strategies and ensures your ROI estimate is realistic. To strengthen your ROI estimate, run different scenarios. What happens if adoption is slower than expected? Or if support costs don't decrease as much as planned? By modeling best case, worst case, and most likely scenarios, you can make more informed decisions and set realistic expectations. Compare your ROI estimates with industry benchmarks. Research what similar organizations have achieved with knowledge-based software. This can help validate your assumptions and give you confidence in your projections. ROI estimation isn't a one-time task, as your organization uses the knowledge base, track actual results, and compare them to your initial projections. Use this data to refine your calculations and improve future investment decisions. Involve key stakeholders in the ROI estimation process. Get input from IT, finance, support, and end users to ensure your calculations are accurate and your assumptions are realistic. Collaboration leads to better buy-in and smoother implementation. Choose a vendor that offers strong support and resources for implementation. Good vendor support can reduce indirect costs and speed up your time to value. Ask about onboarding, training, and ongoing assistance when evaluating software options. Consider how customizable the knowledge-based software is. Customization can increase upfront costs but may deliver greater long-term benefits by better fitting your organization's needs. Weigh these factors in your ROI calculation. Evaluate how well the knowledge base integrates with your existing systems. Seamless integration can reduce training time and improve adoption, leading to higher ROI. Factor integration costs and benefits into your calculations. Maximizing ROI depends on user adoption. Provide thorough training, clear documentation, and ongoing support to encourage employees to use the knowledge base. The more your team relies on the software, the greater the benefits you'll see. After implementation, continue measuring ROI regularly. Track key metrics like time saved, support ticket volume, and customer satisfaction. Adjust your processes as needed to maximize the value of your knowledge base investment. Communicate your ROI findings clearly to leadership. Use visuals like charts and graphs to highlight key results. Focus on how the knowledge base supports business goals and delivers measurable value. Clear reporting helps secure ongoing support and resources. Let's look at a real-world example. A mid-sized company implemented knowledge-based software and saw a 40% reduction in support tickets within 6 months. Employee productivity increased, and customer satisfaction scores improved by 15%. These results translated into a 120% ROI in the first year, demonstrating the tangible value of a well-executed knowledge-based project. Watch out for common pitfalls when estimating ROI. These include underestimating indirect costs, overestimating benefits, and failing to account for user adoption challenges. Being realistic and thorough in your calculations will help you avoid surprises down the road. For the most accurate ROI estimate, use real data whenever possible. Involve multiple departments, validate your assumptions, and revisit your calculations as new information becomes available. Accuracy leads to better decision-making and more successful projects. Many knowledge-based platforms offer built-in analytics tools. Use these to track usage, identify popular content, and measure improvements over time. Analytics can provide the hard data you need to support your ROI calculations and demonstrate ongoing value. Ongoing training ensures your team gets the most from your knowledge base. Regular updates and refresher sessions help maintain high adoption rates and maximize the software's benefits. Factor training into your ROI calculations for a more complete estimate. Establish feedback loops with users to identify areas for improvement, collect suggestions, monitor usage patterns, and update the knowledge base regularly. This continuous improvement process helps sustain ROI and keeps the software aligned with your organization's needs. Remember, the value of knowledge-based software extends beyond immediate ROI. Over time, it can transform how your organization shares information, solves problems, and serves customers. Consider both short-term gains and long-term strategic benefits when making your investment decision. To estimate ROI for knowledge-based software, define your goals, identify all costs and benefits, gather accurate data, calculate ROI using the standard formula, and consider additional metrics like payback period and NPV. Involve stakeholders, plan for risks, and track results over time. This structured approach will help you make the best decision for your organization. Estimating ROI for knowledge-based software is a powerful way to guide your investment decisions. By following a structured process and using real data, you can demonstrate the value of your investment and drive better outcomes for your business. Thanks for watching, and good luck with your knowledge-based project.